Welcome to the Hamilton Wealth Partners second weekly podcast with our special guest, Mark Burgess. I'm Will Hamilton. We're bringing these webcasts to you to assist in providing some clarity during this very difficult period and one in investment markets, which is very uncertain. Before I introduce Mark, I do need to read a general advice warning. This information contained in this webinar has been contained as general advice only. The contents have been prepared without taking into account your objectives, financial situation, or needs. You should, before you make any decision regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether this is appropriate, having regards to your objectives, financial situation, and needs. Mark needs little introduction, being the former CEO of our country's future fund. However, he's now on the board and chairman of the investment committee of industry fund HESTA, chairman of the Australian equity manager Yarra Capital, chairman of the advisory board of bond manager Jamieson Coote Bonds, chairman Asia for OMFIF, a global think tank focused on central banking and financial markets. He's also a board member of a large family office, advisor to IP Group, a leading investor in early stage academic research, enterprise professor at the University of Melbourne, chairman of the Melbourne Girls Grammar School. He's a governor of Cerebral Palsy Foundation and chairman of DB Foundation, supporting state school students who reach tertiary education. Mark has worked internationally, including as London-based executive vice chairman and CEO of Credit Suisse Asset Management, EMEA, and Global CIO of Equities, multi-assets, other global CIO roles for American Express, Colonial First State, and Bankers Trust. Mark therefore knows and has a great understanding of asset classes and their role in portfolio construction and therefore asset allocation. Thank you for joining us, Mark. Welcome, and we can't wait to hear from you.
Thanks very much, Will. I'm going to just give a brief discussion on what I'm observing. For licensing reasons, I'm presenting on behalf of Jamieson Coote Bonds, just by way of background. But more importantly, I wanted to give you my perception, at least, in terms of what I'm observing in the financial markets. If I stood back from it, though, and just sort of hit a summary first, I'm sure many people on this call have seen many corrections. We've all seen the financial crisis. But one of the keys to a good correction is a good investment process. And while I won't go through that necessarily today, keeping your head and being really clear about your objectives and how you're going to manage through this, I think is important. And the reason I mentioned that is that what I'm going to talk about now is my opinions about what's going on. But really the very best investment process has a kind of process around it so that regardless of what your opinion is, you're able to navigate it and most importantly also profit from it looking forward. I thought I'd just step back just a little bit and talk about just what was occurring just before financial markets corrected on February, around about mid-February. I'd been out talking to some of the clients of Jamieson Coote Bonds and others about what we were seeing in the world, and I was making the point that there are about 10 or 12 factors that have been extremely positive for investors over the last 35 years. And the reason I was talking about such a long period of time is that one of those factors has been a long-term decline in interest rates, which has been a very powerful factor in terms of returns that you get from long duration assets, things like private equity or infrastructure, and particularly things like property. And we were making the point, though, that there are many of these other factors that were beginning to deteriorate. That in fact, things like strong economic growth globally, or good demographics, or high profit share in the corporate sector, or geopolitical stability and peace and some of these other dynamics appeared to be fraying at the margins. And we were saying, well, why is it that the financial markets continue to move through to much higher levels? And I used a chart which looks at an issue that is rarely talked about, which is economic volatility. You often hear economists talk about the growth rate and how disappointing it is or how good it is, but low volatility is very important. And this was particularly important marching up to mid-February because the Fed last year, as you'll recall, in early 2019, had cut interest rates and kind of shown the markets that they were prepared to step in and support growth. In other words, continue the long run of smooth economic volatility that we'd seen post the GFC. In fact, there's a word for this which was coined pre to the GFC, which is called the Great Moderation. And in effect, the Great Moderation had come back. There are many reasons why you get low moderation, but the central bankers will tell you it's because they've been in doing good central bank work, but really it's things like high service sectors, a global trading system which smooths out inflation, and a whole range of other issues. I say that because the markets were repricing through 2019, not because growth was strong or not because the corporate sector was particularly powerful, but the perception that economic volatility was going to remain smooth. Because if you can have low interest rates and believe that volatility is going to remain smooth for a long period, you're prepared to pay a lot for risk assets. As it turns out, of course, volatility is what we're dealing with now, and it's the shock to the system that is so profound. But I wanted to set that up because it's important to know that the markets were in effect pricing in volatility even without recognition as and so we started in mid-February. The other feature I get asked about, and I'm sure you've thought through, is why were the markets so violent in their correction for the virus? Well, clearly the virus is a very significant event economically, but I just happened to be in the US in mid-February, and we were visiting all the major investment players and their teams and seeing them for another role that I have. And in the first week we were there in mid-February, nobody mentioned the virus. In fact, we had to ask them. That is very unusual to get a dislocation between what's going on in the rest of the world and domestically in the US in this case. And so there was extreme lack of complacency. In fact, only one VC firm in San Francisco had signs up saying, please don't shake hands. They seemed to understand that it was emerging, but it just wasn't well recognized inside the US. And so once it was, the speed with which the correction occurred was very violent and very severe, and that's not surprising. In effect, the market had been caught short on an important change of information. I mentioned that correction also because it set up a range of very violent outcomes in terms of the way the markets behave, and you'd be very familiar with this, but liquidity dried up, people needed to reposition portfolios, anywhere that there was leverage required very quick action, and that caused that bout of extreme volatility, including in things like the Australian dollar that got as low as 55 cents. I also mentioned economic volatility because this long period of low volatility that we've seen implicitly changes the way people behave. And here in Australia, we've obviously seen it now for a very sustained period. And this has resulted in, for example, the housing sector, people being comfortable holding much higher levels of debt than they normally would. Low volatility creates complacency, and low volatility, in effect, creates comfort with rising debt levels and other outcomes which are prevalent through the financial system and were prevalent up until mid-February. And so everyone says that rising debt's because of low interest rates. That's true, but you'll only do it if you believe that the system around you is reasonably stable. And so that we've, again, coming into a period with the virus that is very much at the optimal level of low volatility after a long period. And so we're trying to adjust to that. I'd like to turn to what's now occurring in relation to the virus itself and the way the markets are responding. As I said, the markets were very, very quick to correct, became violent and dysfunctional. And even in simple markets like government treasuries, they became very, very difficult to trade in. But other areas became particularly distressed. I will add, and a point I should have made about low economic volatility, one of the other characteristics that we've seen in financial markets pre to this virus is that this sense of low volatility has encouraged people to invest in areas that they shouldn't, or perhaps aren't really that aware of in terms of risk. A concept that I call silent risk that is difficult to see, but has been emerging inside the financial system now for at least the last couple of years on the assumption that the world will remain smooth for a period. And so they are classic examples such as people holding credit funds or people holding assets in a bad location. One of my favorites is that we've been funding technology investment in VC over and over again through this cycle without the normal correction that would occur to shake out the winners and losers. And so there's a lot of this kind of implied silent risk still in the system, and that needed to be shaken out during the correction. So the market has corrected. We know that's corrected by 35+% in the listed equity market, but now it's suddenly trying to rebound. And I just want to try and put the context of the virus and how we should think it through, at least in the very short term. Clearly, the virus, the significance of the virus is whether the length of period that this affects the economy. And we all know this. This is kind of obvious. And the reason that's obviously important is that we've effectively stopped cash flow from operating in the system, and anything with debt or anything in a balance sheet is immediately under stress. I think one positive in the current situation is that we've become expert at crises. And I would say that generally speaking, central banks and certainly on the fiscal side have moved very, very quickly and very, very aggressively. The GFC is fresh in people's minds, and so it's also fresh in policymakers, and in reality, they've tried to band-aid over this situation quite fast, at least at this early stage. The challenge for all of us as investors is that we actually don't know how long this will go for, and certainly I'm not qualified to guess, but I do fear that people are pricing in a sort of V recovery or a W recovery, some sort of easy recovery that will get us through this period before things like balance sheets come back to hurt us one more time. I'm always cognizant, though, that equity markets are very good at forecasting. They do tend to want to try and turn early. I pulled out a favourite book of mine by a strategist called Barton Biggs. He wrote on the Second World War, and you might know this, but the time to buy UK equities was when Hitler first marched through Paris personally. And so markets do smell the turn, even though the environment around you is very, very difficult. I think, though, in the current situation, I guess one observation I would make is there seems to be a tendency to want to buy the dips here. I came back from overseas and I was amazed to hear from other institutional investors that they were rebalancing their portfolios even after only the first couple of weeks of this downturn. And I hear anecdotes from people wanting to buy dips all the time, as opposed to thinking through the process and waiting to find out the breadth and depth that this crisis could develop. Having said it's hard to forecast, I'll have a shot at it. I do think it's going to be a messy exit. The exit could happen. It could happen well here in Australia in some domestic areas, but we could be pretty certain, I think, that it will not be easily opened all over the world. And my concerns are in areas such as emerging markets or others, or in global travel, where clearly we're likely to only allow certain countries in at certain stages. And so the functioning of things like tourism is likely to be stunted and certainly not easily recovered. So I guess I'm concerned that the markets are bouncing around. There's a lot of volatility, but I would be a bit careful about the process of re-entering. That said, when it is time to re-enter, it'll always be painful. I think Will and the team have probably mentioned that because he mentioned to me the other day. And that's why you need to have a good process to make sure that you enter the markets at the right time. The other thing I'd say about the rebound in the markets is that there are still many pockets in the financial system that are assuming low economic volatility that are yet to be played out. So, for example, we've created non-bank credit systems since the financial crisis. They are yet to be played out to see how they will respond, on how they are currently responding to a sudden cessation of payments of interest and businesses under stress. We don't know, for example, whether we're building embedded unemployment here and the degree to which that will be a factor in future economic growth. And we also don't know exactly what corporate damage will be done through this cycle. I will say, though, that even with all of those factors in place and the short-term dynamic, I'd be prepared to have an estimate that the 12 or 13 factors that I talked to clients about and others pre-February are still in the system. In other words, the issues that were changing around us over the last 2 to 3 years that we need to start positioning for portfolios in the next decade, I think have only got stronger in terms of their challenges. And then you overlay some additional challenges that come out of the virus situation, and we're in for a more difficult period than we've seen in the last 35 years. I'll just go through some of those components in just a moment, but I would emphasize that I'm not necessarily bearish. It just means that you have to be a better investor in the next period because the environment is likely to be more challenging. The most obvious of those is that global economic growth has been struggling for some time. And the reason that it's struggling, at least part of the reason, is that demographics around the world, which have been very strong in the last 35 years, are now turning into a phase where demographics are not going to work well. And in fact, many countries are going to have negative population growths or declines in population, which can have a significant impact on both their growth, but also the behaviour of the financial system. And so areas like Italy or Germany even, or Russia, South Korea and others are facing strong demographic challenges, and even places like China have strong demographic challenges. One area that I'm monitoring closely is that places like India, Indonesia, Philippines, and even Brazil, they're the demographic hopes, and Africa looking forward. And I guess one of the dangers here, and I think it seems likely this will happen, is that they are unable to manage this virus well, and it'll do serious damage both to their financial systems, but very sadly to the economies and the people of those countries. And we need to watch that, because they were going to be some of the hopeful growth drivers in the next decade, and they seem to be unlikely, or they may not be as strong there as we would hope, particularly if this results in, say, political turmoil. And just watching our neighbourhood here in Indonesia would be an interesting example of that. But other drivers that have been very strong in the last 35 years, high profit share, for example, has all helped us in ownership of equities. We don't know how the virus will work. It is possible, for example, that we will get some more monopolies or oligopolies as some things close down. You can see the discussion here in Australia around, say, the airlines, but that's happening in a number of industries. That said, an outcome of the virus may be that the clear issue is that governments are going to need to raise taxes or reposition their fiscal situation, and they may do that by, for example, increasing taxes on the corporate sector. But I think some of the other 13 factors that have been very positive in the last period that, again, are likely under some stress here. There's no question that the US-China relationship has not improved through the virus here. And in fact, we did a call with the think tank that I'm involved with last week with very, very seasoned people close to Chinese policymakers. And it's very clear that China has seen an opportunity here in terms of its own strategic positioning, because the US has dropped its leadership to a large extent. I guess the thing that I would most talk about, though, in relation to the changing dynamics looking forward, is that interest rates are somewhere clearly near some sort of a low and are likely now to probably trade sideways for a sustained period. This means that that tailwind that has helped your portfolio over the last period is no longer going to be as strong. And let me just explain the tailwind, and I'm sure you're very familiar with it. But as I was saying before, falling interest rates are very, very good for repricing long duration assets. And this is why things like private equity, infrastructure, real estate have become such significant components of portfolios and such powerful return assets, because they get a lot of leverage from falling interest rates. But in the next period, whether we'd had the virus or not, the decline in interest rates, the effect that that has in terms of creating great returns, is going to be less powerful. And in fact, the selection of the assets that you make, the quality of the assets and the way the asset is chosen will be a far more significant element. And the sort of joke I make is that there's not an infrastructure manager in the world that doesn't think he's a great infrastructure manager, pre-virus, but going forward, they're going to be sorely tested, because the fall in interest rates won't just keep rising asset values. They'll actually have to choose the asset values, the assets themselves, very carefully, and if they make mistakes. But this is going to be repeated in a whole range of other areas where selection of the assets, selection of the fund manager, and the way you go about deciding how to invest will be a far more significant component than just the tailwinds of, as I say, falling rates boosting returns. As I say, I am a bit concerned about the impact, particularly on emerging markets, and what it does to global economic growth. But I think also we've got other issues, say, around supply chains and some of these changes that were already beginning to occur, but the virus is raising serious questions for people regardless. I just want to briefly turn to Australia before, and then going back to maybe some questions. But in the presentations I was doing pre-February virus downturn, I was making the point, and this is probably well understood by everyone on the call, that Australia's economic growth rate actually has been quite poor. And the reason for that it's not as obvious, perhaps, certainly not to most people in the community, is that really, in my opinion at least, growth in the last 4, 5 or 6 years has been primarily driven by immigration. It is very easy to create growth by throwing population growth at it, but you should look behind it to see what quality of the growth is. And our GDP per capita, in other words, adjusting for the growth for the rising population, has actually been deteriorating for some period of time. I was telling the story, and I guess I continue to tell the story, that I'm concerned that we as an economy have not got great foundations for economic growth. What we have had is low government debt, and thankfully that's been the case, because the low government debt is now being played out in the form of fiscal stimulus, and that will help smooth the economy. But as we come out of this, out of the other side of this, which I think will take longer than most people expect, the challenge for Australia is whether the core growth engines are as powerful as we'd like them to be. Secondly, the challenge for Australia is that if the immigration profile of the country doesn't keep growing, there are a number of sectors that are probably going to have a setback. And the example that I give is that in Australia, we have 9.5% of workers in construction. That compares with other countries at 5 or 6%. And the reason we have that is because, again, it's a population growth story. We will probably be a great place to live. We are a great place to live. And the way we manage the virus, at least so far, will certainly encourage people to come here. But I heard the HSBC economist talking today, and he makes a very good point, is that the population growth may have to stop here for some period, and that will have ricochet effects on a whole range of domestic markets, including potentially the housing market. And particularly if the unemployment rate remains up, people may start to look to sell off investment properties because it was always going to be a rise in unemployment that would unlock any imbalances in the housing market, in my opinion. So we're in a somewhat sticky position. The government spending so far is about stabilising the economy, and I think there'll be an additional temptation by the government, particularly federally, to try and tax or try and get some of that fiscal spending back so that the balance sheet is restored, all of which creates a difficult growth period, possibly for Australia. But this is going to be repeated around the world, which is why, unfortunately, it tends to suggest that the virus isn't just how it behaves in the shorter term, but it's also the damage that it's doing to fiscal and other balance sheets on a more medium-term basis. I just want to touch on one thing that's been kind of concerning me for a long period, is the assumption that the central banks will always bail us out. I've been talking about this again the last couple of years because everywhere I go, even for non-investors, they ask me about who's going to bail us out, even without the recession being obvious. We've begun to learn the 1987 stock market crash, which I saw, was one of the first times that the central banks showed their power. They learned from the Depression, and they've been, in effect, propping the market all the way through. Well, this time around, the central banks have done it again, I guess to their credit, and fiscally we've done it. But the markets, I think, on a 10-year view will start to wonder whether we really have seen the ultimate end of that process, and therefore investment markets will start to question whether on the next downturn we're unable to support the economy. In fact, I think in a worst case scenario, we may find out in this cycle, particularly if for some reason the virus has a second rebound and globally fiscal gets tested again, we're really on the cusp of questioning whether the fiscal and monetary does have the power to stabilise the economy. And if that gets thrown into question, watch out, because volatility in investment markets is going to follow on straight on behind. I'll just conclude though by saying that I'm not bearish per se. I know it sounds very bearish, but our themes looking forward are that it really is about good selection and good identification of moments to enter markets. And I've said this in the institutional markets and others, that working with stakeholders, either yourselves, working with your advisors, or working with others to have clear processes is a very, very obvious investment tool. And I think it'll be particularly powerful looking forward. And as I said before, it is very clear to me at least that interest rates are now going to probably trade sideways for a period. And it means the tailwind of falling rates that are boosting your portfolios is no longer going to be a factor. And it's the actual assets you buy, the way you manage them, the way they're managed on your behalf, that'll be so critical to the success of your portfolio looking forward. So perhaps that's all I had to say really, but I'd be very open to questions, and particularly people got questions both about the view, but perhaps also what I'm seeing in other places, either institutional or otherwise.
Thank you, Mark. Look, Mark just has kindly offered to answer questions. If you go to the bottom of the toolbar, you'll see Q&A, and you can type a question in there. We do have our first question from Matt. What do you anticipate the inflationary impact to be as a result of the stimulus packages recently undertaken by governments, both domestic and global?
Yeah, that's a good question by Matt. I hope Matt's young, because people like myself have spent the last 15 or 20 years stopping ourselves from thinking inflation's around every corner. But I think the reality is that many of the things that have helped inflation to be low are coming under pressure. So one of them, for example, is global supply chains. We're beginning to see spikes of inflation in areas such as food production, but in other areas we'll see supply chain issues where inflation may come back. But we'll see other forms of inflation across the system because it's not going to work as smoothly as it has previously. On the flip side, we have a system that is also extremely indebted, which is normally deflationary in style. And I think the two factors will come into play here. I can see why Matt's asking the question, because we're seeing unprecedented use of monetary policy, unprecedented use of fiscal, the sort of factors that set up inflationary surges in the 1970s. I think it's going to be a dynamic that rotates rather than one that causes a significant uptick in inflation. In some countries, we may unfortunately see inflation bursts driven by financial or other imbalances where the currency is under pressure and imbalances in their current account or debt positions cause domestic inflation. But yeah, I think the premise behind Matt's view would be is that I don't think it's a one-way bet in terms of low inflation. There's going to be pockets of it, and it's going to be a sort of a risk factor now that perhaps people haven't paid as much attention to in recent years.
Stuart's asking, can you give comments about the quality of assets into the future? What do you think of the role of index funds going forward?
Thanks. That's a good question. Look, I think it all depends on your belief around active management. But if you do believe in active management, which obviously I do, I think this is going to offer fabulous environments. And remember, active management's across the board. The very active decision of a portfolio constructing and how to position your portfolio, how to position, say, your domestic versus international assets, the positioning of the A dollar, that's an active decision itself. And I think that's going to add huge value, including the way you re-enter the markets here if you've currently got cash. But even behind that, as I was saying before, I think the choice of who's selecting your managers and how it's selected will be far more significant than it has been in the previous cycle. Often when you get a very simple trend, things like index funds look very simple. They look like a simple solution. But once you get dislocation, that's where the real money's made. And, you know, so I'm a fan of that, particularly in the current environment and based on what I've said about my thinking for the next period of time.
Amanda's asking, is there anything that you are optimistic about?
Well, I'm optimistic that the markets have come back, right? And that creates opportunity. It was very, very difficult talking to people last year. You could feel the pain of some who prepared their either advisors or they themselves were building cash. You know, it's really, really hard in the late stages of a bull market when you fundamentally know that imbalances are in the system and you want to, from a risk adjustment, for risk reasons, prepare yourself for the possible downturn. So that's happening, and that is good news. And you will find pockets of them, and there'll be clear areas of allocation. An example that I was giving just prior to the virus becoming part of the financial markets from mid-February, we're talking about distressed investing. You know, a feature of the current market is that distressed investing appears to be very, you know, a good place to look. The point I was making, and this was before we saw this correction, is that choose your distressed investor carefully. Because, you know, the one thing we learned from the GFC is that distressed investing does work. It does work well once you get a correction like the one we've just seen. But I was cautioning people that there were many people out there that claim to be a good distressed investor that I don't think have the personality to do it well. And so you need to pick carefully. But that would, for example, be an area where clearly you want to have a look, but be very, very careful because there's many fund managers that are searching around for ideas to sustain the business, which doesn't mean they're necessarily skilled. And I'm not thinking of anyone in particular, but I think that's the kind of value add that you're going to have. But there's no doubt markets are down. This is a great chance on which to start to get positioning or at least to be thinking through the way you're going to get positioned. And that's a much better way to add value than it had been when the markets were just going up, in my view, somewhat unreasonably.
I'm going to disclose his surname here because I also need to explain what he does. So Mark Crosby, he's an economist and a China expert, has asked two questions, so I'll put both of them to you. So I think that there are a few interesting signals to look at re a V or W or other shaped recovery. China's GDP numbers this week, and particularly in the next quarter, my view is that China might recover quickly, but the recovery in Hubei will be key to this. Will they have to lock down? And also other factors are the US particularly, which I'm very worried about. Other factors, question mark.
Are there other factors that we should be worried about? Look,
Asking.
at the risk, because Mark's obviously an expert on China and follows it closely. Yeah, China is, the good thing that we've had, and I think we as a country have benefited from this, is that we have been able to follow the patterns of behaviours of others in terms of being somewhat behind in the process. This is in relation to the virus, for example. But China, we are going to be able to monitor China to see how it responds. And clearly, though, China is being affected by global trade. And the other thing about China, which I think is to their credit, is that they've actually only modestly stimulated their economy through this period. They did two clever things very early on, if you were watching it closely. They dealt with the Wuhan situation, which was clearly a human tragedy. But over on the finance side, they were very, very actively working over their financial system to make sure it survived. And China is very good strategically, and so they taught us a pattern of behaviour. What they didn't do is that they didn't announce major stimulus projects. They've been doing stimulus patterns that are somewhat moderate because they have learnt from the GFC that they don't want further imbalances, particularly in things like credit. That's to their absolute credit because it creates a better recovery. And that's, again, another good example of something we need to watch for, that other countries don't do what I'd call sort of poor policy things that we then have to pay for later on. So yeah, what's China? I think China is now going to probably use this as a chance to lower people's growth expectations. They've known for some time that their growth rate, in my view, is around 5% on a medium-term basis. And I have quite a lot to do with China. I presented at an internal thing up there at Tsinghua University only 18 months or so ago. And they had 2 or 3 foreigners presenting. I was talking about asset management, but another from the US was talking about the medium-term growth rate of only 5%. So I think in many ways we're lucky that China has done this somewhat sensibly. I suspect that their numbers aren't accurate. I think that they're probably getting secondary effects in terms of the virus, but at least we're going to be able to monitor how that works. In terms of other factors, I think the one that's all unknown to us, and I'm sort of speculating, but the length of time that this is in play, I think this is a very complex situation, and we're in a world where the coordination between countries remains very poor. And so we're going to have pockets of this virus being talked about for a sustained period here. And I think that is going to affect confidence and is going to affect the way the economies rebound. So that's another factor that's pretty obviously concerning.
Okay, Marjorie is asking, what do you see as the impact on the superannuation sector, both returns, outputs and response to virus in a sector with huge influence and huge fun?
Sorry, huge inflows, yeah?
Influence. Oh.
Yeah, look, the $20,000 withdrawal, I think, has certainly shocked the system. I think they're managing it. I think they're not in bad shape. I don't get to see it, and I can't comment on HESTA, but, I wouldn't be commenting, I suppose, if I was worried about it. They have got the capability, the industry funds, of having the funds available. I can see why it's being done to some extent, but I am concerned about the effect that it has on the compounding, particularly for young people who may take their money out. In terms of the super system itself, the super system actually should be applauded, and I've often talked about this in the past, that during the GFC, the super system added, with other investors, but added $120 billion to the balance sheets of Australian corporations when they asked for the capital. And so having such a large superannuation system actually is highly beneficial for the operation of the financial markets and offering support behind many of the corporate sectors. I'm sure there are some, so the airline, for example, is one that the super sector is unlikely to support simply because of the sheer challenges in that sector. But across the piece, you can see companies raising capital. That's coming out of super. That's a sign of a very healthy system. It will be interesting to see how super works. Will people lose faith in it? I think we've still got strong returns over the medium term. I think people are aware that superannuation is a long-term investment. We are seeing some switching more than the previous cycle, the previous GFC, but I still think it's relatively moderate given the severity of the market correction. I'm hoping that it just brings us through the people treat this with maturity, and I think Australians generally are well educated in this and do know that it's a long-term saving vehicle. I'd say more broadly, I hope that our policymakers, stop kicking it around. As a country, we've always struggled to raise capital. Well, we've now got $3 trillion plus of capital, and I've got to say, in today's environment, I'd rather have a country with $3 trillion of savings than not. Surely that's better for us as a kind of a functioning economy. I suspect, and I'm hoping that we continue to recognise that it has not just benefits for individuals, but by having everybody saving and preparing, that's not a bad outcome.
David asks, where do you see gold relative to currency markets in this time of QE?
Well, if you've owned gold, congratulations, and it really became an unloved asset, and I think there's a bit of a lesson there. And of course, it became an unloved asset at the time that it started to have some of its negatives peel away. And so one of those negatives, again, as you'd be aware, is that gold's not a yielding asset. And so people were always concerned in the past of having it. I'd treat gold like I'd treat anything else in your portfolio. And this gets to the way your total portfolio is constructed. Again, prior to the virus, I was talking to a lot of people about getting prepared, not that I was anticipating a virus, but because it was late cycle, to think through the way your total portfolio behaves in the downturn. Gold is not in many portfolios. It probably, in my view, probably has a role to play. So do, believe it or not, I believe bonds, but I do, advise Jamieson Coote bonds. There are assets, the allocation of which will give you diversification. And, I used to run the Future Fund, and one of the key features of the Future Fund is that we worked very hard to find lots and lots of ways to survive anything and profit from everything. And, gold has a possible component in a portfolio to give you stability that you may offset with risk. And so I'm not personally a gold, I don't own gold in my personal portfolios, but I've probably been a bit of a failure recently. But I think it's, it's got a role to play. You did mention currency. Currency often gets ignored. And one of the great positions, and I did use a slide on this, one of my concerns for Australia is our economy is not very well diversified. And what we've seen is large institutional investors increase their offshore versus domestic exposure. And that's inherently a reflection of the sense that Australia is not well diversified. And in the process of doing that, you've also had the chance to diversify your currency mix. And we've seen the benefits of that in this most recent sell-off, that having some offshore currency can also give you diversification benefits that make sense for a portfolio, let alone the fact that when you retire, you are probably going to want to, I was going to say go on a cruise, maybe not, but you are going to want to spend some money in offshore assets, and having that as a sort of diversifier in your portfolio. I think that's been one differential for institutional investors. Those that saw that, the benefits of a higher offshore currency weight have really profited here in the last 12 months or so.
Keith's asking, what's your view on the strength of the EU post the virus? Can the increased debt in Southern Europe all be funded by the German powerhouse? Does this mean, with hindsight, Brexit was good timing for the UK?
Thanks for raising the EU. I probably should have mentioned that in my 12 or 13 things. The EU has been a great project because the world's been quite stable. It's inherently an imbalanced situation because it's as everyone would know, it's hovering, particularly the Euro countries, around a core of constant currency, but without the management of policy and process around it. They looked very shaky about 18 months or so, about a week or so ago, 10 or 12 days ago, when the Europeans appeared not to be able to get their act together and form some policies. They did finally come through in the end, but this is a core challenge for us in the next period here, is that the demographics aren't getting any better in Europe. They haven't really bought into, for example, they're not doing a European bond of substance in this cycle, and there's clear signs of fraying and a lack of leadership across Europe. So I'd watch that closely, and it clearly is one of the factors that has worked well for a long period of time, arguably, but is still yet to be relayed. They have, to their credit, they've stepped in and held their noses a little bit and are buying assets that they said they wouldn't. But we, for example, without getting too technical here, we've got German Constitutional Court decisions coming up and others that will continue to throw those policies into some question. So yeah, it's a source of volatility and a source of concern.
Andrew asks, should equities trade at a premium or discount to averages, given A, low interest rates, and B, inherent uncertainty?
Yeah, well, the market was trying to trade at a premium because of low interest rates, but the assumption of low economic volatility. And I've harped on about that a bit, but it just doesn't get talked about enough. And the reason I looked at this 15 or 20 years ago was that because after the Depression, and I'm not saying we're in a depression, but after the Depression, there was a commonly held belief that equities should yield more than bonds. And that was a direct reflection on the fact that equity has more volatility to it. It has inherent volatility characteristics. As I was going through, how does the next period look? There are bulls in the market that say that at these low rates, that eventually we get through the virus and eventually people start to compete again, and they start to go, gee, the yields on the sort of things that I was hearing a lot of in the last 18 months, which is, gee, I want to own some bank stocks because they're yielding and I can't get yield anywhere else. It is possible that if things stabilize here, that people start to rethink that, and we go through this whole dance again where over the next 5 years, equities race to the roof and people are chasing it for yield. I hope it doesn't happen, because I think inherently what it's doing is that it's kind of chasing returns that don't actually exist. And I'm not, the virus is unique and it's out of left field, but it does remind us that you need to be very careful. Things with equity risk characteristics should be priced accordingly. I think they'll come back. I think that eventually equities do have a strong role to play. They do grow, but I wonder whether it's this time around. The GFC was a warning. This is another warning of the kind of things that can happen in volatility. We'll have to see how much the market thinks that through and prices in volatility, i.e. discounts on equities, because we do live in a volatile environment.
Duncan is asking, is gold likely to be reinvigorated as an asset class as governments, central banks around the world print money? So does this process of printing money debase currencies?
Yeah, the process of printing money in theory does debase currencies. I think that's pretty obvious. Gold has a role to play, I think, because of that situation. What we are seeing governments doing is they're going to follow the Japanese model, which is they're going to, in effect, buy back government debt and cancel it. Originally, I thought that Japan could do that early because they were the first player and people really didn't notice this was going on. But other smaller countries would be unable to do it because their currency would be treated like trash because of it. I think that will probably still play out, that weak currencies with weak structures will not be able to pull some of those tricks. But gee, the US dollar's had a great run here. At some point post this cycle, there's certain to be questions about the fact that the US was running a 5% deficit at a peak of a very strong cycle, but now will have very significant deficits, let alone pension costs and other things. So there's lots of dynamics here that are going to raise the issue about what is the value of a currency, what's the role of central banks playing. Yeah, and just maybe, and I'm not necessarily recommending this, but maybe hard assets like gold offer that play. The other thing is, of course, gold can work well if, for example, we get closing of capital flows or other things that come out of nationalism, where people use the gold as a source of store because they're not confident that they're able to get sources of stores another way. These are all worth watching because there is a possibility here that we continue to get nationalism, which is already bubbling away behind the scenes, that causes the ending of what I've seen over a 30-year period, which is terrific ability to invest anywhere that you like. Will that come into play? I'm not forecasting it, but that's why some of these other asset classes may offer a diversification for you.
Now, Mirage has asked two questions. So how important is the relationship with China? Can we do without China? I think we know the answer on that. And what are your views, short and medium term, on the property market?
Well, look, we cannot do without China. We have effectively, I have this presentation that I use that talks about how we've been becoming more and more concentrated, and everyone's probably now aware of this, that we've been doing this over a long period of time. I am a bit concerned because we have not engaged with China particularly well during this period. We haven't engaged with them during the Wuhan period particularly well. China remembers these things. This is an important part of relationship building. And I just wish we as a country could understand that we just have to have some relationship with China because it's not going to go away. Secondly, I think China themselves also understand that this is an opportunity with the US in flux and effectively turn their backs on many countries. And I think China will play this very strategically. So here in Australia, I think we just have to somehow strike the balance in our relationship with China, with other countries, with our traditional partners. In relation to the Australian housing market, you know, I'm probably not qualified in the sense that I think it's expensive, I think it's overset, and I think it's due for a setback. The flip side is that we've probably, if nothing else, become even more attractive for immigrants over time. But this is an immigration story that's propping it up largely. Interest rates clearly help. I was out in Perth recently, or just before the virus, and you know, they were asking me for investment ideas. Well, I said, why not Perth property? Right, it's already corrected. It's really had a big setback. And they said, oh, the demographics are terrible. People are leaving. And so that's the inverse of what happens with good or bad demographics. But there is a window here, and I think it is worth considering, is what is going to happen if immigration here does slow, which clearly it's going to for at least 12 months, I would imagine, where the underlying demand is weak, supposing the labour markets continue to deteriorate, people are unemployed, the auction markets open up. This is going to be a really volatile period. And this is a theme that, again, we were discussing prior to the virus, is that if you need to raise cash, if you need to get position, you should have, because we think that it's time to clean up portfolios. And I guess I fear that there may be the possibility that there are some people who just maybe one or two investment properties too much, and they'll put them onto the market. And if they put one on, they won't just put one, they'll want to sell, they'll put all five on. Why not? Because you can't get rid of it, and you get this setback of 20-25%. And unlike the previous setback that we saw just recently, the Reserve Bank has very few tools left. And this is why Phil Lowe was so reluctant to cut rates, because he did use cutting rates to try and stop the property market from going through, let's say, a 15 or 20% correction to something worse, because he knows that if you get momentum in the wrong direction, it's very hard to stop. And that really was the play that we saw in the GFC in markets like the US and Europe. I don't think we're necessarily going to go there, but our tool set to prevent it is limited. So it's a much, much riskier period.
Now, Michael's asked, Australians have traditionally had a low exposure to bonds. Is this likely to change in an environment where bond returns may struggle?
Well, I advise you bought Jamieson Coote bonds, so you should take my next comments with a grain of salt, right? but what I will say, and I think it's behind this question, is that Australians will have to reconsider the way they're constructing portfolios as they age. Someone asked before about superannuation. You know, we have defined contribution where we put the onus of the investment decision on individuals. That is a big give for Australia. Australians typically we like safety nets and other things, but I hope that system stays. But in the process of having that system, I think we'll start to think far more about post-retirement income, far more about getting risk-reward trade-offs right. And in that process, I think probably people will own some more bonds. I would strongly advocate, and this is certainly Jamieson Coote Bonds' position, they only deal in government bonds. Separate your bonds, your governments from your credit. And the reason you do that, and this cycle is teaching you that in absolutely clear language, is that you can keep an eye on both. They'll behave differently, and you'll be able to concentrate to make sure that your credit manager is a good credit manager. Credit is actually a really hard thing to get right, particularly as you get volatility in cycles. And so I think there'll be an increasing demand for bonds simply because of the aging of the population, even though the returns are low. But I think in reality, it's just reflected that returns generally will be low through the period, unfortunately.
Chris has asked, you talked about themes, good selection, good identification. Can you expand on this? What are you looking at thematic-wise?
Well, there are many themes to do, and I've sort of outlined some of those to look at, and you know, demographics are a theme, or the growth price of theme, the changing of global supply chains are themes. But actually what it really does come down to is that your selection of your fund manager and your manager behind the assets in which you're investing is absolutely crucial. And I'm not sure how many people on the call, for example, do direct investing, but if you're investing in venture capital or other areas, there's been a lot, because the theme of the last 35 years has had a strong tailwind to it. There are a lot of fund managers that I just don't think are that good in reality. And so who you select and how you select them. So I'll give you, you know, if you choose the wrong infrastructure asset, it will hurt you because the 80% of the return looking forward will be the way the asset behaves, not the revaluation effect of falling interest rates. If you choose a piece of property in the wrong location, that is, you can't turn around, or you can't attract people to, or it's badly thought through, or has a bad balance sheet that you've helped create or not manage properly, that will drive the returns forward rather than just the constant revaluation we've seen recently. That's the kind of thing that I mean. It's a little more micro and a little more real investment orientated, but I just think that that's going to be far more significant. And it gets down to stock pickers and others. How do they pick their stocks? And I think I'm not here to give Will a plug, but we were chatting the other day, and I know that Will puts a lot of thought into the characteristics of the fund manager and the way they think. And I think that will just, be so much more important looking forward than it has been when the tailwinds in the bull market just carried everyone upwards.
Thank you. Look, Eric's asked, you mentioned Australia's low growth. How do you see our future growth and unemployment with low immigration, low tourism, less overseas students for our education sector, all impacting our exports? Australian growth and the Australian dollar look weak, unemployment looking strong.
Yeah, so this gets to my point about Australia's lack of diversification. There's a measure which the AFR has criticised, but I've used myself. I think it is an important measure, a thing called economic complexity. And Australia's economic complexity has been deteriorated. Now, admittedly, it looks at the export side of complexity, and it's a very complex measure. I could go through it, but it's a little boring, but I think it's a sound thing to look at. And the example I give for complexity when I talk to, say, an audience is, if your son or daughter does robotics in Australia, can they get a job in it, or aerospace or something else? And that's a measure of how much complexity there is in the economy. We've been becoming less and less complex, less and less diversified, and I think that's a concern. The reason that I've spoken about this also is I was asked that question about what's a 10-year growth rate for Australia. It's impossible to tell that, but the complexity people have done work on this, and they've found that economic complexity is a good measure or an estimator of your long-term growth. And it works pretty simply, which is that countries like emerging countries become more complex, and if the GDP per capita is low, it's likely that they're going to get a surge in GDP growth over time. But countries that have high GDP per capita like us but have low complexity are in effect over-earning a bit and therefore may come back. And their forecast is only a 2% growth rate. We have been propped up by immigration, and I'm personally concerned that we're not generating the next round of industries for all of our new immigrants and all of our existing population. You cannot just have immigration drive something. Throwing capital at something doesn't create good growth, and in this case, labour. It'll create short-term growth and other issues, but it doesn't necessarily create profound and deep growth. And as I say, the reason I've been talking about this, not just Australia's growth, is that investors are starting to see that there's a bit of a lack of diversification in the Australian market, and so they're beginning to position in other markets to try and get diversification because of that.
Andrew's asked a question which I'm going to reword a little bit because the bond, given your hat at Jamieson Coote, and I know you don't look at subprime credits, but can you therefore give your view on subprime credit at the moment? I think it's probably the way.
Yeah, look, subprime credit has a role in the portfolio. I think if you want to take that degree of risk, it has equity type characteristics, it has other characteristics. And there were moments here, as you would know, that the subprime market, particularly in the US, had very attractive moments. What is different in this cycle, which is actually good for financial markets, is because we had the GFC not long ago, there are many large distressed investors that have raised money. I was actually visiting Oaktree when I was in the US in February, very famous distressed investor. They already had large pools of money lined up for the next downturn. Little did they know the downturn was coming in at that week's time, but I know they've drawn on it. And I was meeting with the co-founder there. Howard Marks is the most well-known, but Bruce is the investor. And so people like them are actually going to help stabilize the system because they're stepping in and doing distressed investing. But as I said before, what I'd caution is that not every distressed investor is good at it. The one thing fund managers know is that distressed investing can be attractive, but the kind of people who are good at distressed, in my view, have a personality trait which is distressed by their personality. They're very, very focused, very detailed, very good at identifying the ups, downs, and sideways of a distressed situation. And so who you select, particularly in a market like that, is absolutely vital, because if you have a distressed manager who doesn't see all the distressed elements, they'll get staff turnover and you'll be holding the baby, holding illiquid assets without good people managing it. So choose your distressed manager carefully, or your below investment grade manager carefully.
We're going to make this the last question, and there are some outstanding questions after this, and we'll try and get back to you. Look, the questions have been fantastic, and this is the 18th one of them. This is a very good question, the last one as well. So are there likely to be obvious winners, losers in terms of states, territories here in Australia?
Well, clearly in the short term, there are some losers relative to others. And again, the market gets onto this very quickly, but tourist-related areas or other areas. Victoria is very contingent on, for example, education. And a question was asked before about education, as is New South Wales. But, you know, I'm not sure what the outcome of this is going to be in relation to our relationship with China, for example. We know that China is preparing its tertiary sector to effectively replace foreign universities. They're improving their game there. So there are going to be pockets. I think it's unclear that any one particular state is necessarily going to shine, but there's some others where you need to be careful, simply because the free flow of tourism and other things that dominate some areas will be one example of where that is going to be difficult. The one thing I would say is that, and others will have a view on this, but I've generally been impressed with the leadership that we've seen in Australia. We so often don't talk about it, but we get stuck into our politicians, but they do seem to have galvanised and really crossed the way, and it appears to be pretty much in most states. So, you know, in that sense, at least the leadership in the short term has been good.
I'm going to wrap it up there, but Mark, thank you very, very much. Your insights were invaluable. I think you can tell from the attendees just the insight they got from it as well, given 18 questions. And there are some outstanding questions, and I'll speak to Mark separately about those, so I apologise. But just on the basis of time, we do have to wrap it up. Thank you, the attendees, for listening. Mark, thank you very much for all the effort and time you put into this. It's very, very much appreciated. We will be having our third webinar invitation going out this afternoon. Thank you, everybody, and I'm going to call it a day there, and have a great afternoon. Thank you.
Thanks very much.